I firmly believe the foundation of wealth is property. To support that point, I quite often talk about phones, which is a bit weird, but let me explain. I believe there are only two forms of sustainable competitive advantage in the world. One is brands and the other is people. And if you're the owner of Coca-Cola or something, then potentially you've got a global advantage that's very difficult to overturn. However, for the people that are currently investing in things like Nvidia, it's a technology stock. And what do we know about technology? I'm an engineer, physics is my number one subject. There's a thing called Moore's Law. I don't know if you're familiar with that, but what that says is the power of computing doubles every 18 months. Mm-hmm. And therefore, what was, super intelligent and fantastic 18 months ago is half as good now. Mm-hmm. And if I take you all the way back to 2007, 2008, that's when the iPhone was launched. And the iPhone, pretty much since then, has been the dominant handset technology. Prior to that, it was Nokia. Do either of you have a Nokia phone?
Not anymore, but I miss that little snake game.
Do you know what Nokia do now?
No.
They make car tyres.
What?
And take a different example of that, around about the same, or a few years earlier. If I talk about BlackBerry, you'll probably think about fruit, aren't you?
No, I do remember the phone.
Do you?
Yeah.
Okay. So where's BlackBerry now? Do you know any BlackBerry users now? So you've got these super dominant global companies, you'd have thought, just getting ripped to shreds by the incomer.
Yeah.
And if you had all your money in Nokia shares or BlackBerry shares, today you'd be skint, wouldn't you?
Yeah.
So as an example.
But you might have a nice set of tyres.
You might have a good set of tyres, yeah. And I could give you so many different examples on that. If you think about the US stock market, two things. It's really quite scary. And this is primarily, I guess, addressing the why wouldn't I have all my money in stocks and shares? Because the classic balanced portfolio that an advisor that's trained and authorized to give you advice and has spent umpteen years doing it will classically give you a 60-40 portfolio, by which they mean 60% stocks and shares, 40% bonds.
Yeah.
How the hell's that balanced? It's 100% in the financial markets over which you have no control. So maybe come back to that in a second. But if you think about the S&P, or if you think about the NASDAQ, from when a company enters the S&P to when it dies, do you know what the average lifespan is? 10 years.
Is that it?
That's it. They either go bust or they delist and go private again. And if you think about American stocks, so I'm now going to agglomerate the NASDAQ, the S&P, and the Dow. I'm going to put all three of them together. Now, if I take you back to the early 1970s, so this might be a little bit technical, pardon me if it is, tangible assets, intangible assets. Tangible asset means you don't touch it. This couch is a tangible asset. My thoughts, my IP is intangible. Got it? I'm going to be asking questions. So
always a teacher.
Always a teacher.
Yeah. So if you go back to American listed company spreadsheets in the 1970s, so broadly 50 years ago, 5% of their balance sheet value was intangibles, was brand, was goodwill, that sort of thing. Any guess what it is today? So it used to be 95% tangible, 5% intangible.
I definitely think it's gone up with the rise of personal brand and everything like that as well.
Flipped.
Completely flipped.
95% intangible, 5% tangible. So you go look at the assets of a big company. What is it? You're buying goodwill. And the PE ratios, for anyone that knows what they are, have gone mental, in my view.
Well, Nvidia, for example.
Would be an example. Warren Buffett, who I admire deeply for many different reasons, says that in his view, his analysis, 60% of listed companies in the United States, and listen to this, everybody, will never make a profit.
Wow.
Not make a small profit. They will never make a profit. I'm old school. When I buy a stock or a share, I want a dividend. Mm-hmm. So this isn't an advert. I'm not telling you to do this. I'm just giving you an example of what I've done. So around about 8 months ago now, I got very interested in the DAX, so the Frankfurt Stock Exchange, and I bought a few shares. And to give you an example, I bought Volkswagen. I bought a particular type of Volkswagen share. Why? Because everybody's saying, oh, Volkswagen's going to get hammered, tariffs, this, that, and the other thing. Their PE ratio when I bought was 3. Their cash reserves were off the scale.
Yeah.
So I just got paid a 7% dividend in my bank. Thank you very much. And the shares have gone up since I bought them.
Yeah.
But the received wisdom was, oh, stay away.
Yeah.
So that's kind of reason number one. Technology and the markets, they're not what they were. Mm-hmm. Reason number 2 is, and this is going to sound like I'm kind of being anti-property. I'm really not. I just want to draw some examples of why balance is good. So if you go back 20 years to the early 2000s, or maybe, early to mid 2000s, in order to purchase a typical UK property in gold, not money, in gold, you would have needed approximately 12 kilos of gold. If you just work out the average house price divided by the average price of gold per kilo, you needed 12. Today, or this morning actually, just before you guys came and kindly joined me, the average price of gold is £81,000 a kilo.
Yeah.
Per kilo.
Yeah.
The average house price is 300,000. So you don't even need 4 kilos. So has the house price gone up from 100,000 to 300,000? Has the value of money gone down? Is the value of the house expensive or not? Because if you'd have bought 12 kilos of gold in the early 2000s, you could now have 3 houses.
Yeah.
Or you could put that as deposit on 12 houses or whatever.
Yeah.
The thing you cannot ever take away from property is leverage. The vast majority of money that you use to buy a property is not yours, typically. You get a mortgage. And 75, 80% of the purchase price, therefore, isn't your money. So to counter-argue against my gold argument, if I'd have had £100,000, let's say, in 2003, whatever it was, I could have bought £100,000 worth of gold, or I could have bought £400,000 worth of property.
Yeah.
That £400,000 worth of property, if you triple that, which is what's happened, is now worth 12 times more.
Yeah.
That's interesting, isn't it?
Very.
So leveraged property is performing about the same as gold. From a capital perspective. Obviously, from gold, most people don't know how to get a yield. I do. I get 4% yield, but whatever. That's not really the point.
Yeah.
So for most people, it's relatively simple to borrow the money. Capital appreciation is great. You get profit from rent. And without going through all of the asset classes, they've all got different benefits. But the key reason why I wanted to learn to trade, because it's not something I've ever done, and go back to Warren Buffett again. So by trade, I mean holding an asset short term. I don't really care what it is. I'm much more of a long-term fundamental investor is naturally where I've learnt my trade, I suppose, over the last 40 years. But Warren Buffett says, and it's always true, and please always remember this if you're thinking about doing something new. Warren says, risk comes from one thing, not knowing what you're doing.